There is a version of your life where you are doing everything right and still falling behind. And the unsettling part is not that this is happening to you. It is that no one around you seems to notice it is happening to them either. You are checking your balance before you fall asleep, not because you are in crisis, but because something in the back of your mind wants to confirm that you are still okay. That the number is still where it was, that nothing has moved without your permission, that the slow arithmetic of your life is still adding up the way you need it to. And most nights, it is fine. Most nights the number is acceptable. But acceptable is not the same as secure, and somewhere beneath the surface of your daily routine, you already know the difference. You have read the articles, you have downloaded the apps, you have at various points in your adult life made serious commitments to understanding your finances, to tracking, to saving, to being more intentional about where the money goes. And yet here you are, in roughly the same position you were in 2 years ago or 5 years ago, with a slightly higher income and a slightly more expensive version of the same life, wondering quietly where the distance went between where you are and where you thought you would be by now. What if the reason that distance exists is not a failure of discipline on your part, but a feature of a system that was designed to keep you exactly here, informed enough to feel in control, distracted enough to never actually be it? That is what this video is about. Not about budgeting, not about investment strategies, not about the 10 habits of financially successful people. This is about something quieter and more structural than any of that, about the architecture of modern banking and the psychological mechanisms it has built into the ordinary moments of your financial life, not to help you build wealth, but to ensure that you keep generating it for someone else. No one told you this was happening. That is, in many ways, the entire point. Consider a Tuesday morning, which is not a remarkable morning in any particular way. You wake up at approximately the same time you always wake up. You make coffee or you buy coffee, depending on the version of the Tuesday you are having. You sit down at a table or at a desk or in the front seat of a car, and without deciding to do so, you open your phone. Not because you planned to, not because there was something specific you needed to check. You opened it because opening it is what your hands do now in the quiet moments between one thing and the next. And somewhere in those first 12 minutes of the day, before you have spoken to another person or eaten anything or made a single conscious decision about what kind of day this is going to be, you have already engaged with money in some form, even if only to feel a small, brief flicker of anxiety about it before pushing the feeling back down and moving on. Maybe you saw a notification from your bank. Maybe you ignored it, which is its own financial behavior, a decision dressed up as a non-decision. Maybe you noticed a pending charge you had forgotten about and felt the quiet irritation of someone who knows they do not have the complete picture of their own financial life memorized. Maybe you saw your balance and felt relief, or not quite relief, or something in between that does not have a precise name but that you have felt many times before. This is the first financial moment of your day, and it happened before breakfast. Then the day continues. You go to work, or you begin work, or you exist inside the particular shape that your working life has taken. At some point during that day, a small expense will present itself. A lunch, a coffee, a subscription renewal, a convenience that costs $9 or $14 or $22. Something that sits below the threshold of what you consider a significant financial decision, and therefore passes through your attention without resistance. You pay it without quite paying attention to it. This is not a flaw in your character. This is a behavior that has been carefully cultivated over time in you and in everyone around you, because the financial system is far more profitable when your smaller spending decisions feel frictionless. Later in the week, or perhaps later that same day, you will encounter a larger decision, a bill that is slightly higher than expected, a repair that cannot be put off any longer, a purchase that you have been quietly wanting for several weeks, something you have looked at online more than once, something that appeared in your social media feed at least twice before you went looking for it yourself. You will weigh it. You will feel the competing pressures of the thing you want and the responsible voice in your head that maintains a running commentary on your financial choices. And you will make a decision, to buy or not to buy, to defer or proceed, without being fully conscious of the many forces that arrange themselves around that moment to make one choice feel more natural than the other. This is a completely ordinary week. This is the week of almost every person you know. And inside this ordinary week, a system is operating with extraordinary precision. Here is the behavior. You keep a small financial cushion, not a saving strategy, not an investment, just a number in a checking account that feels like a buffer between you and emergency. You contribute to it inconsistently, you draw from it occasionally, you feel better when it's higher and worse when it's lower. And this feeling is, in a real sense, the primary service this money provides you. Most people would call this sensible. Most financial advice would agree with you that having some liquidity is better than having none. But the psychological truth underneath this behavior is something more specific than sensibility. What this cushion actually provides is the feeling of control in the absence of a real understanding of your financial position. It is not saving, it is emotional management. It is the specific sum of money that allows you to move through your days without being overwhelmed by financial anxiety, which means it is not working for you in any productive sense. It is working as a sedative. And the banking system understands this better than you do, which is why the interest it pays you on that money is, in most cases, almost nothing at all. Your bank knows that you will not move this money.
Not because you are irrational, but because moving it would reintroduce the anxiety that it is currently suppressing. The cost of the psychological comfort you receive from this buffer is paid in the spread between what your bank earns by lending your money out and the near 0% it returns to you. You have, without realizing it, entered into a transaction, your peace of mind in exchange for a yield that does not exist. This is not predatory in any dramatic sense. There is no villain in this story. It is simply a system that learned to read the emotional needs of its customers and to price the product accordingly. The reversal goes further. Consider debt, specifically the way most people experience the decision to take on debt. The popular narrative is that debt is a failure of self-control, a consequence of spending beyond your means, a problem for people who lack discipline. But the actual psychological mechanism of debt is not primarily about discipline at all. It is about the present being more emotionally vivid than the future. When you are standing in front of something you want, or something you need, or something that would resolve a present discomfort, that present reality registers in your nervous system with an intensity that your future financial obligations simply cannot match. The mortgage payment in 20 years is abstract. The relief of solving today's problem is immediate and real. The banking system did not create this feature of human psychology, but it did build an entire industry around monetizing it. The credit card is not, at its core, a convenience product. It is a product built on the gap between how strongly you feel the present and how weakly you feel the future, and it charges you, on average, somewhere between 15 and 25% annually for that emotional arbitrage. There is a third behavior worth observing carefully because it is perhaps the most invisible of all. It is the behavior of financial avoidance, the small, consistent choice to not look too closely at your finances, not because you cannot bear to face them, but because looking closely tends to make you feel worse without giving you a clear path to feeling better. Avoidance is not ignorance. It is a coping strategy that developed in response to a real experience. That engagement with your finances tends to produce anxiety without resolution, so the mind gradually stops initiating it. What financial avoidance produces, practically speaking, is a population of customers who do not read their statements closely, do not notice fees accumulating at the edges of their accounts, do not compare rates between institutions, and do not switch products even when better options exist. None of this is accidental from the banking system's perspective. The design of financial products, their language, their length, their visual complexity, is calibrated, consciously or not, to maintain exactly this relationship between the customer and the fine print. You are not distracted because you are careless. You are distracted because distraction has been made extremely comfortable. The modern banking system, when you observe it without judgment, is a remarkably coherent piece of engineering. It does not function the way most people intuitively imagine it does, as a vault where your money sits until you need it. What a bank actually does with your deposit is lend it out, typically at a multiple of what you placed there, through a mechanism called fractional reserve banking that most people have heard of without fully sitting with what it means. When your money enters the bank, it does not wait for you. It goes to work for the bank, generating returns that are not returned to you in any meaningful proportion. This is not a secret. It is disclosed in the terms of your account, which you agreed to without reading, not because you were negligent, but because the terms of financial agreements have been written for generations in a register that discourages engagement. The legal language is not difficult to understand in the abstract, but it is long enough, technical enough, and presented in a context, the moment of opening an account, of needing a loan, of signing for a card, where emotional momentum feel both unnecessary and slightly odd. Normal people, you are implicitly told, trust the process. Normal people sign here. The credit system, which is perhaps the single most powerful behavioral mechanism in the modern financial landscape, is worth understanding at the level of its design rather than its surface. Your credit score is presented to you as a measure of your trustworthiness, of how reliably you repay what you owe. But what it actually measures, more precisely, is how reliably you engage with credit products. A person who has never borrowed money has, by definition, no credit history, and therefore no score, and therefore limited access to the financial system, even if they've never missed a payment in their life because they've never had a payment to make. The system rewards participation in debt, not the absence of it. This is not an oversight. It is the incentive structure functioning exactly as intended. The interest rate environment that most consumers experience on a daily basis is not determined by some neutral force of markets. It is shaped by institutions, central banks, commercial banks, regulatory bodies that have their own interests, their own pressures, their own relationship to the money supply. When interest rates on savings accounts remain low for extended periods while interests on consumer credit remain high, this is not a coincidence or a failure of the system. It is the system producing its intended outcome, channeling money from depositors to borrowers at a spread that sustains the institutions in the middle. Consumer financial anxiety is, from the banking system's perspective, a feature that requires careful calibration rather than elimination. Too little anxiety, and consumers spend recklessly and default. Too much, and they disengage from credit products and hold cash. The optimal level of financial anxiety, the level that keeps a person engaged with financial products, responsive to marketing, and motivated to maintain their credit score, is the level that exists in most people's daily lives. Not crisis, not comfort. A kind of permanent low-grade unease that keeps them moving, spending, borrowing, and repaying in the cycles the system is designed to sustain. You were not born into a neutral financial environment and then shaped by your choices. You were born into an environment that was itself already shaped by history, by policy, by design, and your choices have largely operated within a range that this environment defined for you long before you were old enough to notice it. At some point, when you have been sitting with all of this long enough, something shifts.
It is not a dramatic shift. There is no moment of revelation, no sudden anger, no conversion experience of the kind that financial self-help tends to promise. It is quieter than that. It is closer to the feeling of adjusting your eyes in a dark room, things that were always present becoming visible as shapes, as outlines, as structures you can now trace even if you cannot yet fully name them. You begin to notice, for example, that almost every financial product you interact with has been designed around a specific theory of your psychology. The credit card rewards program does not exist to give you free flights. It exists because the people who track this data know that you will spend, on average, more when you are spending with the intention of earning points. That the gamification of spending reduces the psychological friction that would otherwise make you pause. The reward is real. The behavioral shift it produces is more valuable to the issuer than the reward costs them. You begin to notice that the structure of your loan repayment schedule, whether it's a mortgage, a car loan, a student debt, places the majority of the interest at the front of the repayment period, when your emotional relationship to the debt is most active and when the principal reduction feels least meaningful. By the time you are paying down significant principal, you've been conditioned to the payment as a fixed feature of your life, something you work around rather than question. This is not an accident of mathematics, it is a design choice. You begin to notice that the friction involved in leaving a financial institution, in closing an account, in transferring assets, in renegotiating terms, is never accidental. The hold times, the multiple verification steps, the conversations with retention specialists trained in the specific language of re-engagement, these are not inefficiencies in a well-meaning system. They are the system performing exactly its function, which is to make staying cheaper in psychological terms than leaving. And you begin to notice something more fundamental than any of these specific mechanisms. You begin to notice that the story you were told about money, that those who have it earned it through discipline and intelligence, and those who do not have it failed in some equivalent personal way, is not a neutral description of how financial outcomes are distributed. It is a narrative that the system finds extremely useful because it locates the cause and the solution of financial difficulty in the individual rather than in the structure. It keeps the analysis personal and the structure invisible. The system does not require your ignorance to function. It functions quite well with informed participants who are too busy, too tired, or too emotionally taxed by the ordinary demands of their lives to act on what they know. Information, it turns out, is not the bottleneck. The bottleneck is the gap between understanding and action, and that gap has been very carefully widened. This is the thing you are now seeing, not because someone handed you a key, but because you are watching your own financial life with a slightly different quality of attention than before, and that difference is, for now, enough. There is a temptation when you reach this kind of understanding to want something to do with it, to translate awareness into a plan, to find the 3 steps, the 5 rules, the clear pathway from here to somewhere better defined. This is a completely human response to the discomfort of seeing a system clearly. The mind wants resolution, wants the anxiety converted into action, wants the insight to pay out in the form of a next step. But the most honest thing that can be said at the end of a conversation like this one is that awareness is not a strategy, and quiet is not the same as powerlessness. What changes when you see the system clearly is not your options. Most of your options remain structurally similar to what they were before. What changes is the quality of your relationship to your own financial decisions. The choice you make from a position of understanding is a different kind of choice than the one you make from a position of habit or anxiety or inherited assumption, even when the choice itself is the same. You are no longer reacting, you are observing and then deciding, and that is a different orientation to your financial life than the one most people live inside. The system will continue to function exactly as it has. The interest rates will be what they are. The credit products will continue to be structured the way they are structured. The marketing will remain sophisticated and the fine print will remain long and the friction of disengagement will remain real. None of this changes because you understand it. But you, moving through this system with clearer eyes, you change. Not into someone who has escaped anything, not into someone with a secret advantage or a revolutionary insight that others lack, just into someone who is slightly less available to be moved without your knowledge. Someone who can look at a financial product and recognize the specific emotional need it is designed to address in you, and then decide, calmly, without urgency, without the performance of either compliance or rebellion, what you actually want to do. That kind of clarity does not announce itself. It does not feel like a victory. It feels more like standing in a room you've lived in for years and noticing for the first time the precise dimensions of the walls. The walls were always there. You are just no longer pretending they aren't. If you watched this far, something in this conversation resonated with you, and that's worth sitting with for a moment before you move on to the next thing. This channel is built for the kind of thinking that doesn't fit neatly into advice columns or financial tip lists, for the longer, slower, more uncomfortable conversations about money and psychology and the systems that shape both. If that's the kind of conversation you want more of, subscribing means you'll be here when the next one comes. And if something in today's video touched something specific in your own experience, a pattern you recognized, a moment that named something you had felt but not yet articulated, the comments are a place to put that thought if you want to. Not for debate, not for comparison, just because sometimes it helps to say the thing out loud, even in writing, even to strangers. Take care of yourself.